Hi, welcome back. This is Khushid Alam from BDO. Today we will be discussing about impact to consider fraud and money laundering in the financial statement. Let's first discuss about the fraud. The issues to consider regarding fraud. Over the past years, a series of high-profile accounting and auditing stories in the media have highlighted the importance of auditors. This has made auditors to remain vigilant for potential fraud scheme in all phases of the engagement. It is important that auditor maintains fraud awareness for potential frauds. Some of the recent corporate scandals are FTX, Wirecard in Germany, NMC Health in UAE. As discussed, the auditor maintains fraud awareness for potential fraud by reflecting on individual and engagement team responsibilities, applying appropriate audit procedures, properly using confirmation, exercising our professional judgment and professional skepticism. Now let us deal with the responsibilities regarding the matters of fraud in the financial statements. The auditor responsibilities to obtain reasonable assurance that the financial statements are free from material misstatements, whether due to fraud or error. The objective of the auditors are to identify and assess the risk of material misstatement of the financial statements due to fraud, to obtain sufficient appropriate audit evidence regarding the assessment risk of material misstatement due to fraud through design and implementation of appropriate audit response, to respond appropriately to fraud or suspected fraud identified during the audit. These requires that we maintain professional skepticism throughout the audit, consider the potential for management override of control, recognize the fact that audit processes that are effective for detecting the error may not always be as effective for detecting the fraud. Let us discuss about the management responsibility and those charged with governance. Management responsibilities and those charged with governance. As part of the system of internal control, companies should implement and maintain a fraud risk management process that include performing a periodic fraud risk assessment to identify new and emerging fraud scheme and risk to fraudulent financial reporting, misappropriation of assets, and illegal acts. Evaluate existing control activities that are designed and implemented to prevent and or detect such fraud risk, and implement changes to policies, procedures, and control activities to address those new and evolving risks. For small entities, the overall system of internal control may be less formal and may not be documented. Nonetheless, the above objectives are still relevant for large, more complex entities, including all publicly listed companies, should design, implement, and maintain more formal documentation process, policies, and procedures. Let us examine the fraud triangle. A fraudulent difference between an error and fraud is intent. Fraud is an intentional act or omission to deceive others. Most financial statement frauds start as small and compound over the several reporting period. The fraud triangles, as you can see on the slide, the fraud triangles refer to three components that leads individual to commit fraud. Pressure or an incentive to engage in fraud. Example, when the individual commit fraud if they are living beyond their means or when there are undue pressure to meet those targets. A perceived opportunity. Example, when there is a weak internal control, it may be easily overridden. And the ability to rationalize fraudulent behavior. The individual may rationalize if there is a lack of cultural values in the organization if they are underpaid. Let us discuss types of fraud. Fraud are typically of two types: misappropriation of assets and fraudulent financial reporting. In fraudulent financial reporting can also be committed in two ways. One is intentional misstatement and one is by override of control. These intentional misstatement could also include the omission of amount or disclosures. Override of control. Fraudulent financial reporting often involves management override of control that otherwise may appear to be operating effectively. Now, what is the guard against those fraud and how to identify those fraud? As an auditor, the most important factor is professional skepticism. Let us see what the other auditing standard says about professional skepticism. They say that ISA 200 specifically mentions that as an auditor, we should plan and perform our audit with professional skepticism, recognize that circumstances may exist that cause the financial statement to be materially misstated. Professional skepticism is basically an attitude that includes a questioning mind and a critical assessment of audit evidence. We should maintain an attitude of professional skepticism throughout the audit. Recognize that there is always a possibility that a material misstatement due to fraud could exist, notwithstanding our past experience with the client or the entity about the honesty and integrity of those management. We should look for more compelling and more persuasive evidence. If conditions identified during the audit causes us to believe that a document may not be authentic or that such document has been modified, we should investigate further. For example, confirming directly with the third party or considering the use of work of an expert to assess the document authenticity. Another aspect of to plan to identify the fraud is engagement in discussion. It is very important that the audit planning process includes all the engagement team, and there should be a robust discussion about the fraud, which involves fraud brainstorming, where auditors think of different ways that the entity financial statement that could be susceptible to fraud. This helps in pinpointing the risk to the material account balances and disclosures and proper audit procedures. Now let us examine the risk assessment procedure. As an auditor, we are required to obtain an understanding of the entity and its environment, including its system of internal control, perform risk assessment procedures. As part of this work, we shall identify the risk of material misstatement due to fraud, as the financial statements and the assertion level by making inquiries of management, those charged with governance, to determine if they have knowledge of any actual, suspected or alleged fraud. Obtaining an understanding of how those charged with governance exercise oversight of management's process for identifying and responding to the risk of fraud and the internal control that management has established to mitigate this risk. Consider whether one or more fraud risk factors are present. Consider any unusual or unexpected relationships that have been identified in performing analytical procedures, including those related to revenue accounts. Considering other information such as interim financial information or information gained from client acceptance and retention procedures that may be helpful in identifying the risk of material misstatement due to fraud. Evaluating whether the information obtained from the other risk assessment procedures and related activities performed indicate that one or more fraud risk factors are present. Let us now see the response to those risk of material misstatement due to fraud. Based on our assessment of risk of material misstatement, we shall determine overall response to address the assessed risk of material misstatement due to fraud at the financial statement level and design and perform further audit procedures whose nature, timing and extent are responsive to the assessed risk of material misstatement at the assertion level. Using CAT, computer-aided audit technology, as a response to fraud risk, using CAT or audit analytics to test the entire population as opposed to samples. CAT or audit data analytics can be used to test the integrity of the information system. They may be an appropriate response when fraud is suspected through electronic means or by IT personnel. CAT or data analytics, such as those using Benford law, can also be used to perform a statistical analysis technique designed to identify fraud by identifying abnormal patterns in data, evaluating whether the selection and application of accounting policies by the entity, particularly those related to subjective measurements and complex transactions, may be indicative of fraudulent financial reporting resulting from management effort to manage earnings. Incorporate an element of unpredictability in the selection of the nature, timing and extent of audit procedures. Let us further continue with the response to the risk of material misstatement due to fraud. In addition, the overall response and response to address the risk of material misstatement at the assertion level, we should perform audit procedure to respond to the risk of management override of control. We should design and perform audit procedures specifically to test the appropriateness of journal entries recorded in the general ledger and other adjustments made in the preparation of the financial statements, review accounting estimates for biases that could result in material misstatement due to fraud, obtain an understanding of the business rationale of significant transactions that we become aware of that are outside of the normal course of business for the entity or that otherwise appear to be unusual given our understanding of the entity and its environment. So that conclude our part of the fraud. Let us also discuss about money laundering. Money laundering is also a very important aspect which we need to consider, specifically in Mongolia. New guidelines has been issued by Bank of Mongolia, where the reporting entity, which includes the auditor, should report to the Financial Information Unit any transaction that they suspect of money laundering or terrorism financing in prescribed form within 24 hours. Now, that is why it is very important for the auditor to update themselves regarding the money laundering. What are the money laundering? What are the type and how it can be affected, so that they are aware of these issues when they are performing the audit. Money laundering is the process by which people attempt to conceal the origin or the ownership of the process of their illegal activities. Money laundering is a particular type of criminal activity. As auditor, we perform certain procedure to ensure that we fulfill our duties in this area. Someone is engaged in money laundering where they conceal. So basically there are three important processes in the money laundering. These are conceal, disguise, convert or transfer asset arising from crime or criminal property. In the second part, entering into or becoming involved in any arrangement that they know or suspect facilities the acquisition, retention, use or control of criminal property by or on behalf of another person. Acquired, use or have possession of criminal property. These include possessing or in any way dealing with or concealing the proceeds of crime. Let us discuss these stages to money laundering. There are three stages to money laundering. These are, first is placement, disguising. Second is disguising the trail. And the third is integration of those money back into the legitimate economy. Let us discuss these stages. First stage is placement. In money laundering, placing the proceeds of crime into the economy. This can be done by breaking large amount of cash into a smaller sum, which then can be deposited into the banks, by purchasing the series of financial instruments which are collected and deposited into account at other locations. Deposit placement can appear innocuous, like someone could arrange a social event charging no entrance fee. They would then deposit those equivalent cash as entrance fee of such social event as genuine income. Let us see the second stage, disguising the trail behind the layers of transaction in order to make it look like legitimate business and also to obfuscate the source of the money. This can be done through purchase, sale of financial instrument, wire the fund through a series of banks across the globe in order to obfuscate the original source, disguise the fund as original payment for transfer of goods or services. The third stage is the integration of the proceeds into a legitimate economy. These may include investing those money after making it look as if it is coming from legitimate source in step 2. Example, the person may invest those money after making it launder into real estate, luxury asset, business venture. Let us see the auditor responsibility regarding those money laundering. We as an auditor, we should be alert to the possibilities of being used by client and third party as a money laundering vehicle, being used to design a money laundering scheme, and thirdly, that the third party is using the client to launder the money. Let us see the audit procedure we should perform. The key audit procedure surrounding the money laundering relates to client identification. We ensure that for both new and existing client, the entity exists for a legitimate purpose. It operates from a known address and it represents legitimate ownership whose identity can be verified. Consider the risk of money laundering within an existing or potential client and reporting our suspicion of money laundering. Now, it is also important we should be aware of tipping off. We as an auditor should be aware of inadvertent tipping off. If we are aware of money laundering, report has been made and we make a disclosure that is likely to prejudice any investigation that might follow the report. As I mentioned, in the Mongolian regulation, there is a regulation called the Regulation of Preventive Measures on Anti-Money Laundering and Combating Financing of Terrorism on money laundering approved by the Bank of Mongolia. The reporting entities shall report to the financial information transaction that they suspect of money laundering or terrorism financing in prescribed form within 24 hours. That's how I conclude my discussion on fraud and money laundering, which could impact the financial statement. Thank you all.